Over the past 6 months, I invested $7 a day and my portfolio grew to $1,248. This is something that virtually anyone can replicate just by changing a few small habits, like not buying coffee every day will give you that $7 needed. During this video, I'll show you what company I invested in, the strategy I used to make these returns, and how you could scale this to completely beat my returns and make much more money. So firstly, what did I invest in? I put my money into the S&P 500 ETF or VOO. Basically, this is just an ETF or exchange traded fund that tracks the S&P 500 index. And this is just a collection of the 500 biggest publicly traded companies in America. The top 10 holdings include businesses like Facebook, Google, Apple, Microsoft, and the list goes on. The top 10 holdings make up 25% of this ETF, giving it a very, very stable foundation of companies to rely on. It also gives you access to lots of different sectors in the market like technology, healthcare, and finance. I really like this ETF because your money is spread out amongst 500 different businesses, and it really increases your chances of making money from it. It's basically the same like being able to bet on multiple horses during a race, instead of the traditional way of investing all of your money into just one stock, and then you're at the mercy of one particular business and you have to hope that it's going to make you money. You can't directly invest into the S&P 500. Instead, big financial companies like Vanguard will buy a license to create an ETF that will track the S&P 500 index, the same way that you can buy a license to use Adobe's programs like Photoshop. So essentially what you get is an ETF that perfectly matches the performance of the S&P 500 index. And if you put the stock charts for VOO and the S&P side by side, you can see that their returns are completely identical. VOO is passively managed, meaning that no one is picking which companies are bought and sold. Every business is included based on the market cap or the total size of the company. So Apple, which is the largest, has a market cap or total value of just over $2 trillion US. So the fact that it's passively managed really cuts down the fees. It means you don't have to pay a lot. Often with a big fund like this, you have a fund manager that will be paid quite a bit of money, anywhere from 1 to 3%, to select which companies are included in the fund. Now, it's not really necessary to pay that fee, since most fund managers can't even beat out the average stock market returns, which you would get with VOO. In that time, I made a return of 10.8%. That might not sound like a lot, but if you consider that VOO, when it first started in 2010, its average return per year has been 13.6%. So we came pretty close to almost doubling that return. And again, just over 13.5% might not sound like the biggest return, but the power of the strategy comes from doing it for a long amount of time. If we used a compound interest calculator to show how much money we'd make if we continue the strategy for 5 years, and we're a little bit more conservative with our return and just put it at 10% per year, in those 5 years your portfolio would grow to $15,396. Of course, you can't use past performance to indicate future performance, but it does give you a nice idea that you're heading in the right direction. I personally felt really motivated once I saw these numbers, and I knew where the portfolio could be if I continued with the strategy. So if you wanted to scale this and increase your returns, you could either increase how much money you put in or extend the amount of time that you're investing for. So if you doubled the amount of money to $15 a day instead of $7 and did this for 10 years instead of 5, you would have just over $86,000 at the end of that 10-year period. With this strategy, it's really effective because you can estimate what your returns are going to be in the future, and it helps to keep yourself motivated and continue with this new positive habit. VOO also pays out a dividend of 1.6%, so that means if you had a portfolio of $15,000, you would get just over $240 per year from the dividend. It's not a huge amount of money, but it's always nice to have as well. Just picking out a low-cost ETF can make you a far greater return than actually using a hedge fund fund manager, which can be paid millions of dollars for actively managing a fund. Warren Buffett famously made a $1 million bet against the hedge fund company, saying that a diversified index like the S&P 500 would easily beat out any actively managed fund. And he was completely right. From 2008 to 2016, Warren Buffett's S&P 500 had an average return per year of 7.1%, giving him a profit of $854,000, where the actively managed fund only gained 2.2% every year, giving them a profit of $220,000. And Warren Buffett ended up collecting all the money from the bet and donating over $2 million to charity from it. VOO has an expense ratio of 0.03%, so for every $10,000 that you put in, you're only going to be charged $3 in fees. The strategy that I used was dollar cost averaging, and this is basically where you put in a set amount of money every day, every month, or every week as well. You're just basically picking amount that you're going to invest on a routine basis, and no matter if the stock market's going up or going down, you're going to be investing. And this just removes a lot of the problems that people will commonly associate with investing, like thinking that you have to spend hours of your time researching companies, looking at stock graphs, or always having to stress about the best buying and selling points for a business. So the way that I set this up is that I had an automatic payment from my bank account into my brokerage platform, and then I had automatic investment from my broker into the S&P 500. So I just set this up to equate to $7 per day. So one thing to keep in mind is the fees that you might be charged for this. Some brokers will charge you a flat fee per investment, while others will have zero fees as well. Robinhood famously has zero fees, so it's very easy to set this up. Stake, which was a more Australian and New Zealand based company, did used to offer zero fees as well, but now they've gone up to $3 per investment. So if you're doing this on a daily basis, it's gonna be pretty expensive. If you're getting charged $3 per investment and you're putting in $7 a day, you're gonna be losing almost 50% of your investment just to the brokerage fees. If you get charged per investment from your broker, I would say doing this on a monthly basis or maybe even fortnightly is going to be a lot better for you. So this experiment really showed me the power of compound interest and how effective it can be. So this just removes a lot of the pressure that can come with regular investing. I know when I had most of my money in Tesla, I was always checking my phone, seeing if the stock price went up or down, and I would be really happy when the stock price went up and I'd made some money, but it would really punish me if the stock price went down. So it was quite an emotional roller coaster. Whereas with this, you know it's a long game and you're just holding it for years at a time, and the daily, weekly or monthly changes don't really matter to you. So I'd really recommend getting into this. And if you're someone that always spends money, say $5 every day on a coffee, it might be nice to see where that money could end up and the profit that you could have if you put it somewhere a little bit more productively. If you want to see some other money saving strategies, check out this video on screen where I show you how I saved $20,000 while on minimum wage.